Today we're going to talk about 5 strategies you can employ when the crypto market drops. Let's get into it. It goes without saying, this isn't financial advice. I don't have a crystal ball. No one can tell you the correct move to make or which direction the market is going to move with absolute certainty. With that out of the way, here are 5 potential strategies you can consider. Number 1, setting stop losses. Most cryptocurrency exchanges have advanced trading mechanisms in place that allow you to trigger an event if a set of conditions are met. In the case of a stop loss, what you're doing is setting a price target or a percentage target where the exchange will sell your asset, the underlying cryptocurrency, and exchange it for a stable coin like USDC or USDT. Stable coins are pegged to the US dollar, so there is, in theory, more price predictability. One USDT should always be worth $1 US. This method helps limit your potential losses, especially if the market continues to slide downward. The risk here is that the market drop was short term and you lose out on any gains you would have otherwise had should it move back up quickly before you're able to enter back into your position. This brings us to number 2, futures trading. I should note that each of these strategies really deserves a deep dive. Let me know in the comments which strategies you want to cover in more detail. With futures trading, as the name implies, you're taking a position that the market will move in a specific direction. You can go long with a trade, meaning you expect the market to move upward in a bullish direction, or you can go short with a trade, meaning you expect the market to move down in a bearish direction. Futures are on the riskier side of things because you can never predict with certainty which direction the market will move. What this is good for is hedging your losses. If you have a large portfolio of altcoins that you intend to hold over a long period of time, but you expect the market to dip in the short term, you may short Bitcoin to protect yourself from those short-term losses. Now, if you're right and the market tanks, the ideal situation is one in which your short position covers all the losses from your long-term HODL account. Number 3 is spot grid trading. I have an entire video on this one, so be sure to check it out after this. Spot grid trading bots thrive on volatility or market moves up and down. The idea here is that you select a crypto token you like, Ethereum for example, and the bot buys equal amounts of Ethereum and USDT, the stablecoin. As the market dips, the bot sells USDT and buys Ethereum. As the market moves up, the bot sells Ethereum and takes profit. Ideally, at the end of the day, you end up with more total money than you started with. The risk and downside is that you have less exposure to the underlying cryptocurrency. If, in this case, Ethereum skyrocketed, you would have less in total gains than if you had just held Ethereum outright. This is called impermanent loss. And speaking of impermanent loss, did you know that only 4% of you watching this right now are subscribed to my channel? If information like this is useful, hit like and subscribe so YouTube knows my content is worth promoting. It really helps me out. And with that, we have number 4. Smart rebalancing bots. This is another one I've covered previously. The idea here is that a trading bot holds a predefined percentage of a number of cryptocurrencies. For this example, let's keep it simple and assume 50% Ethereum and 50% Bitcoin. As the price of each crypto token fluctuates up and down, the bot is going to automatically rebalance to keep that 50-50 split. This strategy is ideal in markets where you have a variety of crypto holdings and the tokens are moving in different directions. As one moves up, the bot rebalances and buys more of the ones that are down. In the end, ideally, you end up with more of each token than you started with. And that leaves us with number 5, HODL. Oftentimes, the best move is to do nothing. The worst thing you could do in trading is become emotional and make judgment calls based on fear, both fear of missing out and fear of losing. If you mostly trade meme coins and chase the next project expected to moon, you are likely going to get wrecked when the market moves down. On the other hand, do research and at least keep the majority of your long-term investments in projects you believe in. If you truly believe a project will be around long-term, then these market downturns are an opportunity to not only hold, but to buy more of an asset at a lower price point. This is where my favorite saying comes in. Be greedy when others are fearful, and fearful when others are greedy. Wise words from Warren Buffett. So which of these 5 did I do over the past few days of volatility? A mixture of a few. For my core assets, I just held, and those that fell the most, I bought more of at a discounted price. At the same time, I have a rebalancing bot running with 12 of my favorite cryptos, and a smaller position of each running spot grids with USDT pairs. Each of these moves and trades were shared with my new Patreon subscribers, so consider joining us at the link in the description. I hope you enjoyed this video. Be sure to check out some of my others and let me know your thoughts down in the comments below. Thank you so much. We'll see you next time.